Problem number 144. Okay. Pamela acquired 80% of the share capital of Samantha on 1st Jan 2001. Part of the purchase consideration was 200,000 cash to be paid on 1st Jan 2004. That is, the payment is happening later. This we cannot compare with lease because in lease, we will be paying an annual rental payment as well. But in this, that kind will not happen. It is a kind of revenue calculation, like that it will be. But from the point of buyer's side in revenue, can you remember that is later you will receive some money as a seller, you will be receiving some consideration later. So that time we will be calculating the amount and we will write it using the discount factor, right? From the buyer point of view, he has to pay later, right? How he will compute, that's what we are going to do it here. So we acquired something and the payment we are doing later. So we are the buyer here. So how we are going to account it? This is similar to, can you remember this decommissioning or dismantling? Can you remember that? Dismantling charges. The future you'll be doing dismantling. So for that, now onwards, you do a provision. Yes. Can you remember in non-current assets we'll be having? Okay, there we'll be having one charge called unwounding discount. Okay, I myself had described it long back. Okay, I'll tell you what is it. So this unwinding a discount, that is if a company is having a future liability to pay. So let me explain that. This I've explained already, but it's been quite long time. So can you see this OneNote, everybody? Can you see this?
Yes, ma'am.
Yes, ma'am. Yes, ma'am.
Okay, so unwinding a discount. Unwinding means, as I've explained it, so this is relaxation, okay? Relaxation a discount. That is in the future you have a payment. I'll give a case also, then you'll understand. So if a company, the same case I've explained already, if a company has a future liability, that is future payment pending, okay, to pay, let us assume it is 5 million after 5 years. And the cost of capital, it's a imaginary problem, okay, 10%. Then what will happen is after 5 years, I'm going to pay something. This is similar to the decommissioning or dismantling charges, like that only. Okay, after 5 years, I have to do the payment and the cost of capital is 10% means what it will do, it will create a provision, right? It will create provision for it from now onwards, right? Based on its PV. Okay. So what will be the provision? I'll tell you. So what we'll do, it will be 5 million divided by 1 plus 10%, that is 1.1% to the power 5. Today, if I'm creating means, so which is divided by, oh, here we can't do that one. 1 by 1.1 5 into 5 million. So this is 3,104,607. So it is $3,104,607. Okay, this is the present value of that. Okay, for this, what they'll do, that is at the time of this arising of liability, this is the value which I have to have it at the end of the year along with some interest quotient. So what we'll do, if I take this value in Excel, that will be great. I'll just take it there. I'll use this workings. So after this, I'll go to the problem. Okay. So if I'm taking, I need this amount, that is 5,000 divided by 1.1 to the power 5. So how much I will get? This is the money which I needed. Okay, and add on to some interest. So year one, how much it will be, year two, how much it will be, three. So like that, I will be relaxingly, see, I'll just pull it up to 5 years and I'll show the calculation. So I will take this calculation first, this amount first. And I know there is a 10% finance cost for this. So it's equal to this into 10%. 10%. Okay. And the year end, the carry forward, how much I'll be having for the year end. This is my liability for that year is equal to this brought forward balance plus this. Like that, I'll just go ahead. So here I'll be mapping this. This is my opening balance and I'll be computing this into 10%. Then I'll be adding. Correct. So this I'll just continue for 5 years. And at the end of the year, I'll be having 5 lakhs, which 5 million, which I'll be paying. Okay. So can you understand this example? Can you understand this example, everybody?
Yes, ma'am.
Okay. So this amount, I'll just expand this. So this 5 million, I'll be paying at the end of 5 years. So this 5 million, how I got it? If I add this amount is my interest every year. Not at the end of the year, I have to pay this interest. So actually, my opening balance is this plus this. Together, it's coming to 5 lakhs. Right? 5 million. It's coming to 5 million. So this is what I'm expected to pay. So this all of a sudden, if you ask anybody to mobilize 5 million, it'll be difficult. So that's reason only this 1,895,393, that is this value. Okay, this value, what is given here, okay, they will unbind it. Unbinding means every year 10% they keep aside. Instead of mobilizing 1 million at one shot, they will mobilize 310 first year, 340 second year, 375 next year, like that. They will mobilize this money and this is a provision. So this together we'll call it as liability of that year. Okay, in the first year, if you ask what is my liability, I'll be telling it is 341,067. In the second year, it will be 300. It keep on increasing. It keep on increasing because this finance cost is adding on. Okay, this principle only we have to use it here. Okay, the what we did here. Okay, this is same like this amount is the this carry forward amount is there. No, this is otherwise called as our non-current liability or deferred consideration. Yeah. So this amount only they are asking. But in the exam kit explanation, I'm not satisfied with that. Okay. In the exam kit, they've just taken first year. When there is a payment, you have to always go like this. Like this only you have to compute. You cannot just like that do it. And I searched for some more problems if it is there or not. I could not find it. So I'll just explain it here. Of course, year end only we are going to pay. So let me take here. So totally how many years? Just tell me. From 1st Jan 2001 that acquisition is happening and the payment is due on 1st Jan 2004. So leave 1st Jan 2004. Normally December 2003. That will be ideal, right? So year end and next year beginning, one and the same. So just tell me how many years are there? How many years you have?
Three.
3 years.
3, ma'am.
3 years. Okay. So that is, I'll just write like 31st, 31st December 2001. Then I have 2002, Then I have 2003, nothing but 1st Jan 2004, whatever. Okay, and the cash to be paid the next day, right? Or else you don't want means put beginning of the year, whatever be the same only, right? So let me put beginning only, why to confuse? So 1st Jan 2001. Okay, so from here if I take, this will be 1st Jan 2002. 1st Jan 2000. And the last year will be 1st Jan 2004. The payment should happen here. But what they are asking, what will be the consideration, deferred consideration liability on 31st December 2002? 31st December 2002 is nothing but what will you have on 1st Jan 2003. So the year end is 31st December. So I go back to that. They are asking what will be the money consideration you're going to pay on 31st December 2002. So here, how much I will pay? That is the question. And how much I have to pay? I have to pay $2 million, right? So this $200,000, what will be the initial value? Is equal to $200,000. Something happened. The keys are not working. Scroll lock or something. Just a minute. Anybody using Dell laptop here? Yes. Is there anyone
Yes,
who
ma'am.
is using Dell laptop?
Yes, ma'am.
So is there any scroll lock as such? There is the keys are not moving now. I could not see.
I
The
know of
cursor is
the
not.
number lock, but not scroll lock. Ma'am. But
Just a
sometimes
minute.
it happens to me also, this problem. I don't know how to fix it.
Just a minute. I need it now. So how to put the formulas otherwise? It will be very difficult. Yeah, what is this? Okay. I don't know. I have to check what happened. So now it's not moving. Cursor is not moving. Sorry. So I'll use a mouse and do it. So it's equal to this divided by 1.1. When the payment will happen? The payment will happen at the end of 4 years, right? So end of 3 years, 3 years, right? So end of 3 years it will be happening. So at the end of 3 years, I have to pay, see, 2 million. Right now, the value is 150,2062.96. So this I will take it here. And for this, I'll be charging 10% interest. Okay, so together the value will be 65,289, like that. This is my opening balance here. I'll take it and I'll be computing 10% for this is equal to this into 10%. Okay. And here this is equal to this, this. I'm getting the answer. Can you make out? So then here I'll be taking this and here I'll be computing this into 10%. Is equal to this amount plus this amount. I'll be paying 200,000. How many of you cannot understand this? You can ask me. I'll explain many times, no problem. But you should understand this.
Ma'am, so it was unwinding. Okay.
Exactly. Unwinding, you have to do, no? The explanation, if you take the exam kit, they've explained. If you choose this option, that option, you will miss unwinding everything. But what they have done is very different. What they've done is different, but what they explained is different in the exam kit. If you open and see, you understand. So I'll just tell you where it went wrong. Just a minute. Okay, this is problem number 144. I don't know. So can you see this? Everyone? See the explanation given. At 31st December 2002, the deferred consideration needs to be discounted to present value by 1 year. This alone they have given. Okay. If you choose C, you have not discounted the consideration. If you choose A, you have not unwound the discount. If you choose B, you have only done the first year calculation. Okay. So this is the explanation given, but they also did just 1 year, 1.1 they did it. There might be some other, this may be a shortcut instead of doing something, but let us go in an elaborate way, which will be easier for you to understand. So this is the year. And this is the carry forward balance, sorry, opening balance, brought forward balance. And this is the unwinding charge, which I call it as the finance cost at 10%. And this is my closing balance. How I got this closing balance? This is brought forward plus finance cost. So first I'm taking the present value. If I'm recognizing this as a liability, this current liability, this is a otherwise I'll call this as non-current liability. This particular column is there, right? This particular column, what is given in the right hand side. So I'll consider this as non-current liability or deferred consideration. Okay, so now this particular column, I'm speaking about this three amount, whatever is given here is the non-current liability or deferred consideration. Since they didn't give in decimals, I also don't want to give it in decimal. So this is the value. Okay, which I got it. Second is the answer. See here, 31st December 2002, what is the value? That's what asked. So first I have to the transaction is happening on 1st Jan 2001 and not transaction. The consideration, that is you have to pay 200,000. The liabilities are rising on 1st Jan 2001. So end of the year, 31st December 2001, for that year, my non-current liability will be this much. Okay, so how I got this? 200,000 I have to pay after 3 years. So what is its present value? I'll find out using the 10% cost of capital, and I'll put interest because the whole year the amount is with me. I didn't pay. So I charge the interest. So I'll add it together and I'll get the value here. And this will be my opening balance next year. And from the opening balance, again, I'll charge 10%, and this will be my closing balance. And again, I'll carry forward here, brought forward here, and find 10% and 200. So ultimately, I'm paying $200,000 on 31st December 2003 or 1st Jan 2004, one and the same. Since the question asked, what is the liability on 31st December 2002? They asked, what is the deferred consideration liability? That is a non-current liability, which is 181,818. Any doubt in this? Can you understand?
Yes, ma'am.
Okay, fine. So I think this explanation will be clearer than what is given in the exam kit. Okay, so we'll go with 145 now, not 145. We're discussing something here. 146. So we were speaking about share exchange. So, and share exchange, and the previous one is it's a share exchange, and the calculation of cost of investment, we did it. And we went to exam kit 144 and 146. Let us do 146. What is there in it? Then we'll go as per the problem remaining. So on 30th June 2004, GHI acquired 800,000 of JKL's 1 million share. So out of 1 million, 800,000 you acquired means what is the percentage of acquisition? Very tough question, no? Please tell me.
80.
80%. Okay, 80% you have done the acquisition. Okay. Now, what is the question asked? What is the cost of investment that will be used in the goodwill calculation in the consolidated financial statement of GHI? So who is the parent here?
GHI.
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 What is the cost of investment calculation? We have done somewhere already. Okay, this is the first time. I thought of copy pasting here because the keys are not moving, very irritating. So fine, just see. So we are going to find the cost of investment. Cost of investment, once again, we'll see the calculation part. The cost of acquisition or cost of investment includes the following elements: cash paid at the date of acquisition, fair value of any other consideration, that is deferred or contingent consideration, and share exchanges. These three we'll consider as cost of investment. That is how much cash you pay, how much you have to pay the future, and if there is any share exchange. Okay, for so many shares of your company, I'll issue so many shares from my company, like that, if there is any share exchange. Altogether, this three, we'll call it as cost of investment. So that we are going to do now. So it's the computation cost of investment. Okay. Now, GHI issued 3 shares for every 4 shares acquired in JKL. On 30th June 2004, the market price of GHI was 3.80 and the market price of JKL was 3. Will you use anywhere the market price of JKL? Will you use it anywhere?
No, ma'am.
No, you'll not use it. No. So why they've given? Just to confuse you here. You need only who is issuing their market price only, you need it. Okay, fine. Let us find out here. So share issued, I use a pen. It's very difficult for me to use without um, the keys. It's very difficult. So I'll use a pen here. So cost of investment. So first I'm going to find out what are the shares issued. So shares issued by, so I'll just write like this, by GHI, the acquiring company, is equal to how much they are issuing. They acquired 800,000 shares, no? So 800,000 shares is their part. So they are telling GHI issued 3 shares for every 4 shares acquired in JHL. So how I can write it?
3/4.
Very good. 3 shares for every 4 shares. So 3/4 into what is the market price of GHI? Because I'm doing for GHI only. So what is its market price? It is 3.80. You have to take that. So if you compute this, so it is 800,000 into 3/4 into 3.80. So you get 2,280,000 rupees, dollars. So it is 2,280,000, right? 2280. Okay. So this is the shares what they have issued. Okay. Then what else is given? GHI agreed to pay 550,000 in cash to the existing shareholders on 30th June 2005. So GHI's borrowing rate was 10% per annum. When they are going to pay? When they are going to pay? They have to pay $550,000. When they'll be paying?
In the next year.
Next year. So don't confuse here. They didn't ask what is the current liability or non-current liability here. They're asking what will be the cost of investment. If it is non-current liability, you have to compute it, then you have to find the finance cost, everything. Now, to consider what is the consideration, that is only the amount, how much you have to write here in year one, what you will take it. Here it will be cash to be paid. So I'll just write it very simple. Cash to be paid on, when it should be paid on 36 June 2005. How much I should pay? I should pay 5 million, right? 5 million, 550,000. Yes. So how will I compute it? So I have to pay that time, but this cost of investment will be computed at the time of acquisition. So the acquisition is happening 1 year prior. So at that time, what is the present value I have to compute? Only the present value, 550,000 divided by 1.1. That's it. Because after 1 year only I'll be doing the payment. So today, if I'm checking, that is this calculation is happening on 30 June 2004. On this date, how much is the present value of the future consideration? That alone you have to take it. So it is 550,000 divided by 1.1. So which is $500,000. So this I'll be taking it here. They didn't ask what is your deferred consideration or what is your non-current liability. They didn't ask that. They asked only the cost of investment, only the present value of to take it. That's 500,000. Okay. Anything else is given? Okay, they've given something else. GHI paid professional fees of 100,000 for advice on the acquisition. What is this? Should I have to add with cost of investment?
No, ma'am.
Why?
No, ma'am. It should be written off.
Expense to.
It is should be expense to profit and loss, right? So I'll add this and the list will come to $2,780,000. Right? So this is my cost of investment. You can give a note that that will be expensed or else leave it, no problem. So 2 million. So I'll write here. Already 3 zeros were taken out to 2780. Any doubt in this?
No,
Any
ma'am.
doubt? No. Okay, so let me go to the theory again. Share exchanges, we have done already. How a share exchange will work, just now we saw. Now, post-acquisition revaluation. That is, if there is a post-acquisition revaluation in the subsidiary company after acquiring some company's assets, after acquiring, you're going to revalue it. Okay, the full amount of the gain should be added to non-current assets if there is a post-acquisition revaluation and there is an appreciation or depreciation. So it will be completely added or decreased to non-current assets. The parent share of the, yes.
Ma'am, can you tell me how he got 1.1, ma'am?
Okay, 1.1 I'll tell you. So it is actually 550,000 today. He is not paying immediately, right? He's going to see, if you see, it is from 30th June 2004. We are computing this entire calculation, but the payment is going to happen on 36 2005, right? So exactly after 1 year it's happening. And you are finding this cost of investment right now. So right now, if you pay means it is 500,000, you can take it. Since the payment will happen after 1 year, you have to discount it. Am I right?
Oh, yes, ma'am.
So this is nothing but this 1.1 is 1, what is that? 1 plus r the whole power n. So 1 plus 10% to the power 1. 1 plus 10% is 1.1, no?
Yes, ma'am. I just want to know why didn't you use 1 divided by 1 plus 10%?
Okay, I'll show the calculation here. See. Okay, 1 divided by 1 plus 10%. If I do it, I have to ultimately multiply with this amount 20, no? So I'll write and show here. See here, 550,000 into 1 by 1 plus 10% the whole power 1. It is same as 550,000 divided by 1 plus 10% the whole power 1. This is same as 550,000 divided by 1.1. Am I right? Hashim,
Yes, ma'am.
got it?
Yes, ma'am, I got it.
Where I was? So in the theory, right? In the post acquisition, what they said, if after acquiring a company, you are revaluing the subsidiary's non-current asset, the full amount of gain or loss, okay, that will be adjusted. It's mentioned as gain only, should be added to non-current asset. And the parent's share of gain is taken to the revaluation surplus, because if there is a revaluation gain, you'll be writing in revaluation surplus, no? So in that acquisition also, you'll be having a portion to the parent and portion to the non-current asset. Sorry, non-controlling interest. So the parent's share will be taken to revaluation surplus, and non-controlling interest share will be taken to gain. Share of gain be taken to non-controlling interest. So I'll tell you here. So you're acquiring some plant. Let us assume plant and machinery. Okay, when you are acquiring at acquisition, the amount was 1 million. After revaluing, the revalued amount is 1,100,000. So this 100,000 is the profit now. Okay, revaluation surplus. Let us assume in this 80% is a parent share and 20% is the subsidiary share. So this 80%, that is 80,000, will be taken to revaluation surplus. Okay, as 80,000. And this 20%, that is 20,000, will be taken to non-controlling interest as 20,000 as profit. Could you understand this explanation?
Yes, ma'am.
Okay, so let us go here. Which problem I have to do? Yeah, illustration 3. Illustration 3 should be above somewhere. Yes, here. So P has owned 80% of yes for many years. Okay. During the current year, P and S both revalue their properties for the first time. So after acquisition, this is the first time they are revaluing, both of them. Both properties increase by 100 million. That is both PPE, that is for P also, this is P and this is yes. Okay, normally parent will come here and subsidiary will come here. You should know that. Okay, and the order also they've given very clearly. P and S means P and S. You have to understand. So there is the revaluations will be shown as follows. So PPE, it's 200. Okay, and revaluation surplus is 180. Non-controlling interest is 20. 1 minute. This is what? Oh, this is not P and S. Okay, this is a consolidated one, no? Yeah, hello. Yeah.
It's journal entry, no.
Yeah, it's a journal entry. That's what. So the revaluation will be shown as follows. They've given here. So let us see how it happened. Actually, the answer is also given here. So let us see how it happened. The explanation part I'll tell you. Okay, because it's an illustration anyway. Okay, so P has a question ends here. The question ends here and they're asking what will be the journal entry. Okay, the question ends here. This is the answer. So I'll just explain you here. So now, just now we discussed something, that is, if the subsidiaries revaluation revalued amount, what we'll do, it will be shared between parent and NCI, and parent share will be taken to revaluation surplus, and the subsidiaries, that is non-controlling interest amount will be taken to non-controlling interest. Okay, that's what they have done here. So they've told both the PPEs increased by 100 million and 100 million each. Both means the parent also revalued its property, right? So parent's property, you keep it aside. The subsidiaries revaluation amount, what they told, the subsidiaries revaluation amount, like how I told, it is 100, okay, $100,000. And they said the parent is holding 80% and the non-controlling interest is holding 20%. So here it will be 80,000 to revaluation surplus, and here it will be 20,000 to non-controlling interest. But when you're writing the journal entry, the parent is also having its own asset, that is 100,000 revaluation. So together it will be 180,000 revaluation surplus for the parent. So that's why, and the entire amount will be added to PPE. That's why you have to write debit PPE, which is 100 plus 100, total revaluation. I'll take it here as 200, and credit revaluation surplus. Okay, in revaluation surplus, we are going to take only the parent. Already it has 100, its own amount, plus 80, okay, which is the share from the subsidiary. So 180, and credit non-controlling interest 20. So this 80 and 20 you understood, I guess. This 100 is nothing but the parent's own revalued assets value. Can you understand this journal, how they have done?
Yes, ma'am.
Yes.
Okay, fine. So let us go to the next one here. This is illustration 3 over. Then intra-group trading. It's a very important topic. Intra-group trading means there is any transaction between the parent and subsidiary. We call it as intra-group trading. That is, sometimes the parent will have some, for example, many examples are here. The debtor creditor relationship we'll call in general. So sometimes there will be a transaction between the parent and subsidiary. That is, parent would have supplied goods to subsidiary. So the bills receivable in the parent account, the subsidiary's name will be appearing. And okay, so bills receivable. And in bills payable column, subsidiary will mention that I should pay so much to the parent, like that. Some intra-group, within the group, there may be some trading. So how you have to treat it and what are the types you have in it? So let us assume P is the parent and S is the subsidiary. So P and S may well trade with each other, leading to the following potential problem areas, because they are a group. Though they are legally a different entity, economic point of view, they are a group. So always substance over form only we will take. So economic thing only we will be considering. So though you tell we are individual entity, considering from us, it is a single entity actually, single group it is. So it is a problem to account such things. So what are the types we have? Normally the current accounts we'll be having, current accounts between P and S, that is nothing but your trade receivables and payables. Okay, then you may have loans held by one company in the other company. That is loan forward. If P is giving a loan to S and S owes to P, like that, if there is any transaction, that is one. Then if there is any dividends issued and any loan interest between those two. And if there is any unrealized profit on sale of inventory and sale of non-current asset, sale of inventory in the sense like if they are transacting, sending goods to parent is supplying goods to subsidiary, or subsidiary is supplying to parent, there should not be any profit in it, okay? Because you will not charge profit to your own entity. So that profit is called as unrealized profit. So if you sold, if that inventory part has been sold, no problem. If anything is remaining as a closing inventory, then you have to remove the profit part of it. That is called unrealized profit on sale of inventory, same profit on sale of non-current asset. If there is any profit, you have to remove it. So let us see that here, how we'll be accounting. First is what? Current accounts between P and S. Only this we are going to see now. So receivables current account is in one entity of SOFP and a payable current account in one entities of SOFP. These amounts, what we have to do is, these amounts are cancelled against each other. You have to cancel it. You should not show it in the consolidated statement. If 6,000 worth of 5,000 worth of goods I've sent to my subsidiary, so my subsidiary have to pay me. So for the parent, it is a receivable. For the subsidiary, the same 5,000 is a payable. Both should be excluded from consolidated financial statement. You cannot show that. You have to deduct 5,000 from both the columns. Okay. In that, one more problem is there. If there is a goods in transit or cash or goods in transit, okay, 5,000 I have to pay. I'm a parent and I have to pay 5,000 to my subsidiary. Already 2,000 I've sent to them. Maybe a net transfer I've done. It will take 2 days to clear, and I have to consolidate the accounts. So it is called as cash in transit. So what is the assumption? The assumption is cash has been paid or received by the other party. If it is dispatched from the parent, the subsidiary should assume it has received it. On that basis only you have to go ahead. So how much ever I explain here, unless we do a problem, you'll not understand this much better. What's the time now? 7 minutes more. Let's try. So cash or goods in transit. So if there are goods or cash in transit, adjust the statement of financial position as if, this is a very important line, as if the goods or cash had been received. You have to assume it has been received, and then you have to end it. Okay. Let's see. Cash in transit adjusting entry will be debit cash receivable, credit receivables. Cash, debit cash, credit receivables. Goods in transit, debit inventory, credit payables. This actually, for the practical point of view, you don't need this journal. But sometimes you may ask 1 or 2 marks in this. For that purpose, you read it. So cash in transit adjusting entry. So normally the payables will pay the cash, right? So if they are paying, so what will happen? My cash balance will increase. Okay, I'll just give an example. So P is there, S is there, and in the parent, there is a receivable of 5,000. But in subsidiary, there is a payable of 3,000 only. This is an intra-group transaction, let us assume. What does it mean? Means subsidiary is telling that I paid 2,000. So they are putting only 3,000 in. But parent didn't receive that 2,000 yet. So what it should be done? So what it should be done here means I have to receive, but I didn't receive. That is called receivable, right? So I have to receive 5,000 and I assume I've received 2,000 already. And now I'll be, instead of showing 5,000, I'll be showing only 3,000. And what I'll do in parent, in the cash, I'll be adding 2,000. Let us assume the cash balance already it is 10,000 in the business means I'll be showing 10,000 plus 2,000. So I'll add it 12,000. Can you understand this transaction? Cash in transit. Cash increases, so it is debit. Asset increases, debit. Receivable decreases, that is asset decreases, so it is credit. That rule is applied here. Could you understand this concept? I'll do a problem and show you. Can you understand a little bit now? What is that intra-group transaction? What happened? People. Yes. Can you understand this transaction?
Yes, ma'am.
Okay. Entire class is silent. So, okay, fine. We'll solve and see a problem. So goods in transit also same way. So if the goods has been sent, okay, so it is debit inventory, credit payables. So here it is the goods are increasing and the payables are also increasing. I've received. So let us assume instead of this P and S, there is a buying and selling transaction. So I have to receive goods from subsidiary. So I have to receive goods from subsidiary. Subsidiary will put it as receivable now for the goods. And here I'll be writing payables. Okay, and stock also will be there in the business. So subsidiary has dispatched the stock already. And here the stock, I didn't receive it, but I have to assume that I've received it. So I will put 2000 as I've received already. And in payables, what will happen? I'll add 2000 because I have to pay for this still. So already some 5000 is there, means I'll add 7000. That's 5 plus 2. I'll be adding and showing it here. This is the treatment. So since how it will be, since stock is increasing here, let us assume already I had a 10,000 worth of stock. And now 2000 I've taken from my subsidiary. So it is 10 plus 2. Stock is increasing. So asset increases. So it is debited. At the same time, my payable is also increasing from 5 to 7. So payable increases, that is liability increases. So credit. So this is the explanation here. This adjustment is for the purpose of consolidation only. After doing this adjustment, you have to cancel the current accounts. Current accounts always need to be cancelled between the parent and the subsidiary. Okay, so this red line is a note which is given. So we'll be seeing illustration 4 maybe in the next class as a continuation. This means that the reconciled current account balance amounts are removed from both receivables and payables in the consolidated statement of financial position. So how it is done, we'll be seeing in illustration 4. You want me to do now or shall we do in the next class?
Next class, ma'am.
Next class, because illustration 4 is a full-fledged consolidated financial statement. While doing that, I'll explain you how to do it. Before that, I'll somehow make this keyboard ready. So someone asked a question here. Okay, someone gave a suggestion. Just a minute, I'll see.